you have a health savings account? If you are enrolled in a high-deductible health plan through your employer or on your own, the answer is probably yes. Most people with access to one have opened one. Most of them will tell you they use it regularly. Here is the follow-up question almost nobody can answer. Are you using it correctly? Thomas is 63 years old. He lives in Denver, Colorado, and has worked as a CPA for 31 years. He has helped hundreds of clients build retirement plans. He knows the difference between a traditional IRA and a Roth. He understands required minimum distributions. He has explained IRMA thresholds to clients in terms they could actually follow. He has also had a health savings account for 15 years. And last spring, while preparing a retirement income projection for a client, he realized he had been making the single most common HSA mistake for every one of those 15 years. His HSA balance at 63, essentially zero, not because he had not contributed. He had contributed every year, close to the maximum, but every time a medical bill arrived, every copay, every prescription, every dental cleaning, every annual physical, he paid it from the HSA immediately, because that is what he understood it to be for. A medical debit card. Tax advantaged, yes, but primarily a place to store money for healthcare spending. What Thomas did not understand, and what almost nobody explains at open enrollment, is that his HSA was something else entirely. Something he had been spending down for 15 years without knowing what he was spending. Have you heard the phrase triple tax advantage? Most people with an HSA have not heard it applied to their own account, and that gap is costing them tens of thousands of dollars in retirement. Here is what it means. When you contribute to a health savings account, that contribution reduces your taxable income in the year you make it. Just like a traditional IRA contribution, when the money inside the account grows through investments, it grows tax-free, just like a Roth IRA. And when you withdraw the money for qualified medical expenses, you pay no tax on it at all. Not income tax, not capital gains, nothing. No other account in the United States tax code does all three of those things. Not the traditional IRA that gives you the upfront deduction but taxes you on the way out. Not the Roth that grows tax-free and comes out tax-free, but gives you no current deduction. The HSA is the only account that gives you a tax benefit when the money goes in, when it grows, and when it comes out. Thomas knew this technically. He had explained it to clients. What he had never done was apply it to his own behavior, because he had always treated the HSA as a spending account rather than an investment account. The math of that mistake is not small. If Thomas had contributed $4,300 per year to his HSA for 15 years and invested it in a diversified index fund earning 7% annually, his balance today would be approximately $127,000 in tax-free assets. Instead, his balance is zero. Every contribution he ever made went in one side of the account and out the other, paying bills that could have been paid from other income. Here is the number worth calculating right now. Take the number of years you have had your HSA, multiply it by your average annual contribution. Then ask yourself, what would that amount be today if you had invested it and let it compound? The gap between your answer and your current balance is the cost of treating an investment account like a checking account. Now let me explain the mistake itself, because understanding why 95% of HSA holders make it helps clarify why the remaining 5% do not. Fidelity's research consistently shows that the overwhelming majority of people with health savings accounts use them exactly as Thomas did, contributing money and withdrawing it within the same year for current medical expenses. The reason is not carelessness, it is framing. When your HR department explains the HSA at open enrollment, they tell you it is for qualified medical expenses. That is technically accurate. They are describing the tax-free withdrawal rule, what the IRS calls qualified medical expenses, which includes the things you would expect: doctor visits, prescriptions, dental and vision care, hospital bills, and a longer list of eligible expenses than most people realize, including long-term care insurance premiums, COBRA premiums while between jobs, and after age 65, your Medicare Part B and Part D premiums. What the enrollment presentation does not explain is that spending from your HSA immediately is optional, not required. You can pay those same medical expenses from your regular checking account, save the receipts, and leave the HSA invested. The tax-free withdrawal is available whenever you choose to take it. Not only in the year the expense occurs, Thomas spent 15 years making the optional choice that cost him the most. Here is the number worth calculating right now. Think about your annual out-of-pocket medical expenses. Now ask, could you cover those from your regular take-home pay instead of from the HSA? If the answer is yes, even partially, every dollar you redirect away from the HSA and towards your investment balance is a dollar working on all three tax levels simultaneously. A dollar you spend from the HSA today is a dollar that can never be all three of those things at once ever again. After age 65, the rules change in one important way. You can withdraw from your HSA for any purpose, not just medical expenses, without the 20% penalty that applies before 65. You will owe ordinary income tax on non-medical withdrawals, the same as a traditional IRA. But the penalty disappears. This means that after 65, your HSA functions like a traditional IRA for non-medical spending and like a completely tax-free account for medical spending. No traditional IRA can do that. This is what makes the HSA the most flexible retirement account most people have never used correctly. Carol is 60 years old. She lives in Portland, Oregon, and has spent her career as a nurse. She understood from the beginning what healthcare actually costs in retirement, because she spent 20 years watching what it costs people who did not plan for it. She opened her HSA at 43 and never spent a dollar from it. Every medical expense Carol has had for 17 years, copays, prescriptions, dental, vision, she paid from her regular income. She saved every receipt. Her HSA balance at 60, $127,000, invested and growing. Here is the piece of the HSA rules that almost nobody knows. There is no time limit on when you can reimburse yourself for a qualified medical expense. If you paid a medical bill out of pocket in 2019 and saved the receipt, you can reimburse yourself from your HSA in 2031, completely tax-free. The IRS requires only that the expense occurred after you opened the HSA, not that you claimed reimbursement in the same year. Carol has 17 years of receipts. She can reimburse herself for any of those expenses at any point, tax-free, while leaving the principal and growth invested for as long as she chooses. At 65, Carol plans to use her HSA to pay her Medicare Part B premiums, $185 per month in 2026, paid completely tax-free from the HSA, her Part D prescription drug premium, her dental and vision costs in retirement. The account that has been compounding for 22 years will begin covering the expenses that are otherwise the most difficult to plan for. The healthcare costs that increase precisely when income becomes fixed. Fidelity estimates that the average retired couple needs approximately $315,000 in today's dollars for healthcare costs in retirement, not including long-term care. Carol's HSA, still growing for 5 more years, will cover a meaningful portion of that entirely tax-free. For your specific situation, how much you can realistically pay out of pocket in the years before retirement, how your HSA investments should be allocated, and when it makes sense to begin reimbursing yourself from that accumulated receipt file, a fee-only financial advisor, or CPA, can model the specific numbers in one conversation. The strategy is simple. The numbers are personal. Here is the number worth calculating right now. Go back through the last 3 to 5 years of medical expenses you paid out of pocket. If you have an HSA and you saved any receipts from that period, you may be able to reimburse yourself today, tax-free, for expenses you paid years ago. That is not a loophole. It is a feature of the account that is printed in the IRS guidelines and used by almost nobody. Thomas is 63. He has 3 years left before Medicare. He will not catch up to Carol, but in those 3 years, he can contribute the maximum plus the catch-up, an additional $1,000 per year for people 55 and older, and invest every dollar. He can stop draining the account. He can start saving receipts. He understands now what he is working with and what he was working with all along without knowing it. Carol is 60. She has 5 more years of contributions, 5 more years of compounding, and a Medicare premium strategy that is already built into the account balance, sitting at $127,000. When Carol explained her approach to Thomas over lunch, they had become friends through a professional development conference years earlier. He asked her how she had known to do it this way. She said her father had died at 72, with $300,000 of unreimbursed medical expenses he had paid out of pocket and never claimed. She decided, at 43, that she was not going to leave anything on the table. If there is one thing I want you to take from this video, let it be this. Your health savings account is not a medical debit card. It is the only account in the United States tax code that gives you a tax deduction today, tax-free growth for decades, and tax-free income in retirement, all from the same dollar. Every dollar you spend from it before retirement is a dollar that can never be all 3 of those things at once ever again. Thomas is 63. He now knows what Carol has known since 43. The account is the same for both of them. The understanding is what made the difference.